QuickBooks Pro Desktop 2021 Credit Memo/Refund Form and Bad Debt Expense. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You can open the home page by going to the company dropdown, selecting home page. We also have the open windows open. You can open the open windows by going to the view dropdown, selecting open windows list. We're down here in the customer section. We've been going over the transactions, the flows, and the transactions, the effect on the financial statements of those transactions, of those forms within the customer flow section, within the revenue cycle or the accounts receivable cycle, as you might call it. We're going to be down here in the refunds and credits, often a very confusing type of form. It's something that's not going to be generally in our normal process. As you can see up top, there's no arrow pointing directly to it. It's kind of like a glitch in the process where we have to provide a refund or a credit memo process in there. Also note that this form will be involved if we're going to be entering bad debt as well. So we want to think about those items. As we think about the refund or credit, how does it fit into the flow? Remember that if we have two types of ways that we can be receiving or recording income from customers. One, we create an invoice, meaning we did the work and we expect to receive payment in the future. Then we're going to get the payment from them, decrease in the receivable that represents the customer owing us. Then we make the deposit, transferring it from undeposited funds into the checking account, or we bypass these two areas. We sell directly at the point in time the work is done, such as selling at a cash register or something at that point in time, collecting the payment at that point in time. That's important when thinking about a refund or credit memo, because you want to be tying the refund or credit memo to something that happened in the past. Either you created the invoice in the past or a sales receipt. If you created an invoice, have you received the payment on it yet or not? In other words, do we have to be giving them money back at this point in time that we have received? Or are we going to be reversing the fact that they owe us money, which would be the case of an invoice that has not yet been paid, meaning we're reducing the accounts receivable. If we're reducing the invoice that have not been paid, reducing the accounts receivable, we could be in essence simply trying to record a bad debt transaction. In other words, we've determined that we're not going to be paid on accounts receivable that we have tried to pay on it. We've been trying to call this person, collect on it, and so on and so forth. Haven't been able to get the collections on it. We threatened them with collection agencies and whatnot. So we're just going to have to write it off. That could be a part of this process as well. So note that one problem with this process, and let's see if we can see this in terms of a scenario by actually opening up the financials first. I'm going to go to the reports dropdown. We're going to go to the company and financial. Let's take a look at the profit and loss standard. I'm going to restrict the dates up top so that we can see one transaction here, 030521, 030521. That'll restrict us to basically this one sales transaction, this one invoice that we had made. So we made this invoice, and the invoice was a sale of something that did have inventory related to it. So the revenue went up, and then the cost of goods sold went up. This would be the net effect of that 76. Now we're imagining here that we're going to be issuing a credit memo for all or part of this transaction, and we have not yet received the payment on it. So let's think about some of the problems with that. First, you might say, if you were to do this, if you're going to say, okay, I'm not going to get payment on this. If I double click on this transaction, I'm going to say, here's the invoice. If I double click on that invoice, you might think, well, why don't I just either delete the invoice if I'm not going to get payment on it, or if I'm going to get less payment on it, I can simply adjust the invoice to, if I'm only going to get $300, I can just make this $300 or so and adjust the invoice to the amount that we're going to get paid. You don't typically want to do that. One, it's not good accounting principle basically to do that, because when you do that, you're erasing the audit trail, meaning what really happened is you had an invoice that was entered, and then you had this situation that happened in the future. You don't want to remake the original entry. You want to show the original entry and then adjust it with another entry so that you can see a consistent audit trail going forward. Also note that if these two things happen in different periods, then you could have other problems in terms of your timing differences. In other words, if this happened in the prior year and now you've determined it was uncollectible, or you need to adjust it in the following year or possibly in the following month, but it's a more extreme example if it was in the following year, then you could have problems with like deleting this transaction, because if you had already recorded it in the year, it's going to delete it as of the point in time the invoice was made. So if you deleted this transaction or adjusted it, then it's going to do so as of this point in time. And if you were in 2022 at the point in time that the credit memo should be put in place, then you're going to have problems like with your retained earnings won't roll over properly. You could have problems down here with the sales tax transactions because you already paid the sales tax in this case, which was the $19. You'll only have sales tax if it's like an inventory item in the US, but if there's a sales tax issue, then you already paid it, and if you delete it, then you already paid it. You're not going to see the reversal that should happen in the current period so that you can get the benefit of the sales tax. It could, mess up your inventory and things like that. So you don't typically want to delete the item. QuickBooks gives you the option to do so, but that's not what you want to do. You want to create the credit memo. So what we would like to do is create then a credit memo. If I close this back out, and again, you can kind of see this on the income statement. Notice this is going to be on the income statement for March or in the year of 2021. It's going to roll into the equity section on the balance sheet. If I was simply to delete this after March had passed, or after we did all of 2021 financial statements, then it would delete it in the wrong period, right? And it would erase the audit trail, and it could have other problems on inventory and the tracking of inventory and the sales tax and that kind of stuff. So we want to create a credit memo. So I'm going to go back to the home page. The couple ways we can create the credit memo. We could just hit the credit memo, obviously, down here. And we imagine that we have a particular customer that's telling us that we're not going to get paid, or we've determined that we're not going to get paid on it, or we have to give them a refund because they want a refund for whatever reason. We might say Anderson. We could type that in. We'll get the data down here related to our invoices and whatnot, and we can use this to basically create the credit memo. I think oftentimes it's easier to actually find the invoice and then create the credit memo. So oftentimes it would look like this. You can imagine Anderson not going to pay us for whatever reason. We're going to say, okay, let's close this out. I'm not going to record this. I'm going to say, let's go into the customer center, which you could do here, or you can go to the customer drop down and customer center. And then let's find Anderson. Here's Anderson. Let's imagine this invoice is the one that's not going to be paid. That's probably the way we would go into it. Then go into that invoice and say, okay, here's the invoice that's not going to be paid. I want to make a credit memo, in essence, based on this invoice. Then you would go up top and say, okay, let's make this credit memo, selecting credit memo up top. And then this is credit memo looks a whole lot like the invoice, but now in essence, it would be reversing, doing the opposite of the invoice. So if that's all you did, and you change the date to basically the current date, let's say it happened in the following year in 2022, 01, 05, let's say 01, 05, 22, in the following year of the invoice, then it would reverse it in the following year, and it would basically do the exact opposite of what the invoice did. Now that may or may not be what you want to do, the exact opposite of what the invoice did. It's quite possible you want to make a slight change to it. So let's imagine that for a second. Let's say that, normally in accounting you would call this possibly a write-off of bad debt expense. We're imagining it's a direct write-off method rather than a allowance method in this case. So I'm going to say, okay, what happened when we made the invoice in terms of journal entries, debits, and credits? If you don't understand, if you don't, have a good grasp of debits and credits, then it's the same thing, up and down, increase or decrease. What happens when we make the invoice? Accounts receivable goes up or is debited. The sales go up or are credited. Sales tax goes up or is credited. That's a payable account liability. We've seen this when we made the invoice. And then we know that cost of goods sold or inventory would go down if we're selling inventory, and cost of goods sold would then be going up if we had inventory. That would be the expense. Now, if we were to reverse the credit memo exactly, then if I was just to enter this credit memo the way it is now, it would simply reverse the entire thing. Accounts receivable would then go down because we're not going to get paid. That's the main point. The sales tax would be reversed, which is what we want to do because we want to reverse the sales tax in the current period, which will give us the benefit now of the fact that we paid sales tax in the past and we never actually got the money from the customer. So we should reverse that or adjust that in the current time period so that we can do it going forward, right? We're not going to adjust the past. We're going to adjust the current time period for our sales tax, typically. And then we're going to reverse, in this case, sales. And this is kind of the iffy item here. Oftentimes, this would be like a negative sales amount. And normally we might not want a negative sales amount. We might want this to go to bad debt expense. Or you might want this to go to sales returns and allowances depending on your circumstances. The bottom line is that typically we do not want to reverse directly the sales. We either want it to go into a contra sales accounts, sales returns and allowances, or typically an expense account, which would be the bad debt expense, which is often the case when you write something off. You don't want to make a negative sales. You'd make it go to sales tax bad debt. So we might have to adjust that one. If you're dealing with inventory and you got the inventory back, then this would make sense. Inventory would go back up for the cost of the inventory, which is driven by the item, and the cost of goods sold would basically be reversed here as well. So the whole thing would basically be reversed. However, you might not be getting the inventory back down here. If you're not going to get the inventory back, or the inventory was damaged in some type of way, then you may not want this second component. You may not be increasing the inventory. You're just basically recording the fact that you had to reverse the credit memo here. Maybe the inventory is damaged in some way, shape, or form. So those are the kind of scenarios you might have. Now, first, the starting point is to think about it in this format, however. And notice in this format of thinking about it, you would first want to think about what the invoice is doing in terms of increases and decreases in the invoice, and then think about the credit memo. If you try to think about the journal entry or what's happening, increasing and decreasing to the accounts when you make a credit memo without first thinking about the invoice, it's way harder because this is not a normal transaction. You haven't done this in your mind a bunch of times. You have done this possibly a lot more times in your mind. Therefore, write that down, then think about the credit memo, and then think about, what the transaction is going to be related to the credit memo. So if we go back over, if we just record this, then that's what's going to happen with regards to the credit memo. It's going to reverse it exactly, which is good for the date. But again, we might want some of those adjustments to it. For example, if I want this to be going to bad debt, then I need an item here that's going to be driving to bad debt. So let's go ahead and set that up. I'm going to say, let's go to the lists drop down, and I want to go to the item lists, and I'm just going to set up an item for bad debt. I'm going to go item, and as I set up this item, I'm also going to set up an expense for bad debt expense, because I don't think we have that either. So I'm going to say new item here. We'll actually record. Note we would do a similar process if we wanted to record this to sales returns and allowances. As this process, we could set up the item for sales returns and allowances. And then when we set up the income or the expense account, instead of having an expense account, we would be recording the sales returns and allowances account, which would be a contra income account as opposed to an expense account. This one. And this is just going to be an other charge item. And I'm just going to call it bad debt. Bad debt. And I'm going to call it bad debt down here as well. And then it's going to be the amount. Is it tax? I'll keep that there. And then we're going to say this is going to bad debt expense, which we don't have set up at this point. So I'm going to add or create bad debt expense account as well. So I'm going to add a new account. It's going to be an expense type of account. So I'll select the drop down, make this an expense type, call it bad debt expense. Now the expense is optional because that's kind of repetitive because it's already in an expense category. So you don't, but in any case, I'm going to say save and close and okay. So then I'm going to close this back out. If I use my open windows, I still have the invoice open. So I'm going to close this back out. And that'll take me back to my credit memo. So let's close this back up. And so now this, if I reverse this one, this is going to be reversed into the sales item. If I use my other item, which is bad debt expense now, and I'm going to say this item is associated with an expense account. Do you want to continue? I'm going to say okay. And so then I'm going to say tab. And I'm going to say instead, I'm going to put this to 380 here in the expense account. Now it's in there twice. And I'm going to remove this first item. I'm going to change this back down to 0. So now what will that do? That will, notice it records the same kind of items down here, but rather than, that change then, what it's going to do is it's going to record, rather than making a negative sales item, now it's going to be going to bad debt expense. It'll still reverse the sales tax here like it should, and the accounts receivable should still be going down. Also, since I have still this first item in there at 0, the sales price is at 0, but it's still going to be reversing the cost of goods sold, because the cost of goods sold is being driven by that item. In other words, if I go to the lists drop down, item lists, maximize this for the Gibson USA, I see the cost here is at the 304. So even though I deleted the sales price, the cost is still known by the system. So it'll still record then this second half of the transaction, assuming that I'm going to be getting the inventory back, right? If I'm getting the inventory back, then it's going to record the second half, basically increasing the inventory, and the other side's going to be going to the cost of goods sold. So I'm going to close this back out, close this back out. Now, if I was not getting the inventory back, if I were not getting the inventory back, then I could delete this first item altogether and just simply record it to the bad debt expense. And that would mean that if the inventory was say damaged, then it would remove the second half of the transaction, and it would only be recording the first half of the transaction. All right, so that's going to be the main items of it. Now, if we were to record this, and again, I'm going to record it on 1/5/22, then it's going to give us a few options once we try to record it. So I'm going to say save and close, and it's going to say, okay, what do you want to do with this? Do you want to retain as an available credit? So in other words, if the client had already paid us, then we might say, hey, look, we're going to give you a credit memo, and then next time you purchase something, we'll apply that credit memo to the next thing you buy. So we can do that. That's not the scenario we've been looking at here. We could give a refund, which means that, again, usually that would be if they had already paid us and we have to give them the actual money back. If you check that item off, it'll give you your payment options, including writing a check or doing some kind of electronic payment. Or we can apply to an invoice, which is our scenario here, writing off an invoice that is open due to it being basically bad debt. We're trying to write it off to the bad debt expense. So I'm going to choose this last one and say OK. And then we see here's the open invoice. So that's the one we're going to be checking off. So I'll keep that there. I'm going to say done. And there we have it. So I'm going to close this back out now. So if I close this back out, close this back out, and then go to the profit and loss report, notice we have the same item here for March, but then if I go to the next year, let's say 01/22 to 01/31/22. So now I'm in the following year where I issued the credit memo. We have noticed no effect on sales. It didn't do a reversing sale. We still have like this negative cost of goods sold, which is a little bit strange because we got the inventory back, but we record the bad debt expense here. So instead of us having a negative sales, we recorded the bad debt expense, and we've recorded it in the following year when we determined that the debt was going to be bad debt expense in accordance with the direct write-off method rather than the allowance method for bad debt. So if I go into that, then of course there is our credit memo on this side of things. And then if I go to the balance sheet, so let's just see our credit memo. If I go to the reports up top, company and financial, and I take a look at the balance sheet standard, and I change the dates, customizing the dates from 01/01/22 to 01/31/22 for the year we made the credit memo in it, so we can drill down on this. The credit memo should be doing this, right? Accounts receivable should now be going down. So if I double click on the accounts receivable, I'm going to say, all right, the accounts receivable decreased. There's the credit memo. If I double click on the credit memo, that's for the full amount, including the sales tax. The other side is going to go to the income statement. So I'll close this back out, close this back out. Profit and loss or income statement. It didn't reverse sales because we fixed it using that item to then go to bad debt expense. So that was that little adjustment we had to do in order to change this from sales to bad debt expense. So we're going to say, all right, there is the 380 there. And that, of course, is for the amount that we charged, not including the sales tax. Then we had a reversal to the sales tax. So if I close this back out, back to the balance sheet, sales tax is going to be here. It's going to be in the liabilities somewhere. There it is, sales tax. And notice it's a reversal to the sales tax. So we're getting the benefit of the fact that we didn't collect the sales tax from the customer, although we paid it. We paid the sales tax last year. So now we're going to adjust for it in the current period. That's going to be a key point here, of course, for our adjustments. And then we know that inventory is going to be affected in our case. So we said the inventory, if we receive the inventory back, I'm going to go to inventory assets. There's the 304. So notice it recorded the book's inventory, the 304, if I double click on this, because we're imagining we got the inventory back. And that was recorded by this inventory item, even though it has 0 in the rate, because the rate is the sales price, and the cost of goods sold is being driven by this inventory item. Closing this back out. Closing this back out. Now the other side of that is going to be on the profit and loss, and it basically reversed out the cost of goods sold. So you have a negative cost of goods sold, which looks a little bit funny there because negative cost of goods sold, because that's the reversing transaction on the credit memo for the inventory coming back in. So it's kind of a negative expense, which you don't typically see, but again, it's reversing the inventory that we're imagining coming back. Now, if I double click on this, you might say, well, what if we don't get the inventory, or maybe like the inventory is damaged in some way? Then maybe we just delete this line, right? If we deleted this line, then it would remove that second half, the inventory going back up, and the negative cost of goods sold, and we would just be tying this out to the first half of the transaction, the accounts receivable, the sales, and the sales tax. So I'm going to close this back out, close this back out. Now also note, of course, if we go to the balance sheet here, we saw the inventory, so the subsidiary ledger for inventory would be in the reports dropdown, inventory, valuation summary. If I make this as of, we said 01/31/22, then we have this Gibson, what was it? It was this Gibson USA has now appeared again. If I double click on it, then we have the Gibson USA. And I'll change the beginning date so we can see the transaction. So 01, and so there it is. So there's our increase from the credit memo that happened. Closing this back out, then also we can see the accounts receivable. If I look at the accounts receivable by customer, going to the reports drop down, if I go to the accounts receivable customer and I want to look at the customer balance detail, and I'm going to make this from 01/01/21 to 01/31/22, let's say. So there we have our detail here. Here we have our credit memo that's going against the invoice right here, and those are tying back out. So then this is back down to 0 because we wrote it off basically to the bad debt expense. So again, the credit memo is kind of a confusing item, and it also ties out to the idea of bad debt. And when you think about the bad debt and writing off bad debt, you want to think, are you using an allowance method or the direct write-off method? We do have courses on that, so you can think about, how to deal with the bad debt itself, and then think about the situation where you're going to be using the credit memo. Where does it lie? Do they still have the receivable outstanding, or have you been paid? Are you issuing a refund? And are you going to be dealing with the fact that you're going to be receiving inventory back, and do you have sales tax involved in the transaction? So then you want to consider those when you're thinking about the credit memo, and just remember that you typically do not want to change anything, especially if it was in a prior year or even a prior month. You like an invoice, you don't want to change the invoice or the sales receipt. Typically, what you want to do is do the proper audit trail, especially again if it's over the cutoff date, another sale or another month, by doing the credit memo and the refund form.